You're now listening to the Tax Smart REI Podcast, the number one tax podcast for real estate investors. Hey everyone, thanks for tuning into this week's episode of the Tax Smart REI Podcast. Today we're joined with Zack Mattos, financial planner and short-term rental investor and longtime client of Hull CPA. He's also a father. We're going to be diving into his story, how he got started into real estate, why he jumped into short-term rentals, what he was able to achieve with those short-term rentals, and a lot more. This is something you're not going to want to miss. We'll be diving into all of that in just 1 minute. Hey, Tax Smart investors, I'd like to invite you to join the 2025 Tax and Legal Summit presented by Hull CPA, taking place September 12th through the 14th, 2025. This free 3-day virtual event is designed specifically for real estate investors who are building long-term tax-efficient wealth. Over the 3 days, you'll hear from leading experts in tax, legal, and real estate strategy. Sessions will cover key topics including how to navigate the current real estate market, structure your entities for legal protection, understand the impact of the 2025 tax bill, avoid common tax scams, and preserve generational wealth. You'll also learn what's changed with IRS audits this year, how to avoid the biggest legal mistakes real estate investors make, and how to efficiently find and fund your next deal. General admission is completely free, but for those who want to take it a step further, VIP tickets are available for just $77. As a VIP, you'll gain access to exclusive bonus sessions, including a private legal Q&A with a real estate attorney, a one-on-one laser session with our tax strategist, and much more. You'll also enjoy priority access and extended replays of select sessions. This is a must-attend event for the year if you're a real estate investor who looks to minimize taxes, protect your assets, and build real lasting wealth. Reserve your ticket for free or grab your VIP pass for just $77 to access the full experience by visiting www.taxandlegalsummit.com/registration. Again, grab your free tickets or reserve your VIP tickets by visiting www.taxandlegalsummit.com/registration today. We'll see you there, but for now, right back into today's episode. All right, and we're back. Zack, thank you so much for joining us here on the show today. Can we just start off with just a little bit of information on your background and how you ultimately got started in real estate?
So thanks for having me. First of all, I would say the thing that drove me into investing in real estate was a book that a client of mine actually recommended to me called Advanced Tax Strategies. You guys heard of this? A little quick, easy read. So my client was telling me these things that he did because he was a business owner. He had a wife that didn't work, and she was very active in the stuff that they had to upkeep for their rentals. And he kind of on a broad level explained how he was taking depreciation on his rentals and using it to offset his non-passive incomes because she was qualified for rep status. And I read the book, and my whole career as a financial advisor at that point for like 20 years was just funding making Roth contributions to my solo 401k. And we had lived in 3 different houses, but I bought and sold, and they were all my primary residences. And up to 2022, I didn't even have a rental property. So I quickly paused my and my wife's max funding of our retirement accounts once I realized what you could do with real estate. And we did a lot to get in. We turned our primary residence we put it to use as a rental in the middle of 2022. And for those first 6 months while we were living there, getting it ready to go on the market for rent, my wife did a ton of work getting it ready to show and everything. And those hours were hugely helpful. And then from, when it was put to use as a rental to the end of the year, there was a lot more hours, but it was that book. And I was shocked because I had been advising people financially on how to plan their life out for 20 years as an investment advisor. And it was all stock market related. It was just brokerage accounts, IRA accounts. Once you leave your company, roll your 401k to an IRA, certain tax planning strategies. But I would say 99.9% of my clients were deficient and very hungry for competence in the tax professional space, including myself personally. Just disappointed. I have a lot of W-2 clients that are 7-figure W-2 guys, and they're just like, is there literally anything I can do? And until reading that book, I had no idea. And then I just really Google searched for tax firms that specialize in real estate, and you guys came up as the most impressive one, to be honest.
Well, we appreciate that. And it's crazy to see how we see the same issue over and over again. A lot of high income earners, whether they have W-2s that are running a business, and they're just hungry for some type of tax savings that's outside of the conventional wisdom that you typically see. And they often land on real estate as being that answer for them. What made you decide? Was it just the tax savings that made you decide to jump into the real estate investing side, or was there any other motivations you had?
I would say the first motivation would be the taxes, but then obviously managing money for folks that are retired. If 100% of your income stream while you're retired is coming from a little Social Security check plus a distribution out of a retirement account or a brokerage account, that can be kind of not the peace of mind that one's looking for in those latter stages of life, where it's like down market year, still got to take 100,000 out to meet my living expenses. And now when I recalibrate my retirement analysis, do I even have enough to maintain spending until life expectancy? So it's like having a fixed income from something, whether it's a pension or, something like rental real estate, is hugely helpful. If you run the numbers on it, if you have a really good portfolio and you compare the net of, the net return you get from a rental property, which one's going to, you can make a case for both. But as far as like the peace of mind during retirement, I've always wanted the smallest portion possible of my income stream during retirement to come from distributions from a portfolio.
Yeah, that makes a lot of sense because if during the down market years, it's you still got to take that money out, right? So
100%, especially about the required minimums, obviously, where it's like if you're 74 and older, if you miss those, isn't it like a 40% tax on what you should have taken out, or 20? What is it?
Yeah, I don't know offhand because I don't deal too much retirement planning, but yeah, we'd have to look into it. I know there are penalties for it, and yeah, that's rough to have to be forced to take the money out.
Even if you don't,
yeah, that's rough. So how have you changed the way you advise your clients to include a portion of real estate now?
Yeah, definitely. Just yesterday with this client of mine in the Bay Area, he has a great, the San Francisco Bay Area, Silicon Valley real estate prices are like, to buy a place that was built in the 70s, you're paying like $2,000, $2,500 a square foot. Like really not an impressive home. It has always been, and it still is ridiculous. That's where I was born and raised. It's ridiculous for what you get out there. But anyways, he has this great house. Him and his wife and 2 kids are growing out of it. And he's like, okay, well, I owe $400. If I sell it for 1.2, then I can get this house in this neighborhood. And I'm like, you shouldn't really think of it that way. You should be diligent and put your head down and save the down payment for like a year or 2 years and keep this place and rent it. And then you'll be, the very first year you do that, and his wife doesn't work. And like the very first year you do that. And I always send people to Justin for like a $500 feel it out session. Will this be a good fit? Do you need to go into a full advisory agreement, or will this 1 hour session give you enough to be dangerous with your own planning? But those are conversations that, since I had this wonderful experience doing it myself and literally paid next to no federal income taxes on my financial services business for almost 2 years, I totally advocate that for my client. It makes me look great, actually, to have that knowledge and to like continually repeat, like I'm by no means a tax professional, but here's a team that helped me, gave me a blueprint and did it like by the books. It seems like when you tell the story, people are like, oh, well, it's got to be doing something in the gray area. And you're like, no, it's actually all in the tax code, and you're just either using it or you're not.
Right. There's a lot of stuff that I think people just aren't even aware of because it's so far out of the realm of conventional wisdom.
Which is crazy. Like, this is literally why I have a 14-year-old, a 13-year-old, and an 11-year-old, and we homeschool all of them. And I teach a Tuesday morning finance class because why is it not conventional? Like, that's the biggest question of the hour. It's like, this should be taught immediately, to everybody.
Right. Like how the tax code works and how to use it in your favor. Totally agree.
Right. Versus calculus.
Right. Which I don't know the last time I used calculus, and I really don't. But just a quick call back here. The penalty is for RMDs is 25% of the amount not withdrawn.
So okay, I have a retiree. They've got about 4.9, call it $5 million, and it's usually about, you have to take out 4% of what you have in there. So what's that? 4%. That'd be 160,000. They would have to take out.
Yep. Yeah.
If they miss that, 25% of 160,000 is 40 grand.
Yeah.
Right. Hold on. 4% of 5 million is 160, right? Yeah.
I think it's 200.
That's 200. Yeah.
Oh yeah. So 200. A fourth of that is 50 grand. You have to pay. They would make you take it out late, pay the taxes, but an additional $50,000 in penalty. And you're talking about 74, 75 plus year olds are maybe a little forgetful. Don't have it set up automatically. It's just outrageous.
Yeah, no, that is, the more and more I look into the traditional retirement accounts, the more and more like it's the less and less beneficial it seems. Like you really have to weigh the tax benefits now of doing it versus, what potentially come up in the future.
I just think it's easy. I think that's why we do it. It's easy. Just make a transfer. You're done. It kind of grows. You don't have to do anything. Real estate is just kind of its own beast of, I've really got to save this. I've got to be intentional. I have access to it, but I got to wait to put that into a property. Then I've got to manage it, find a property manager. It's just more work and it's more difficult. And I think you're kind of like paying a little bit of a price if you're just going the traditional IRA route, 401k route. And it's going to be a little bit probably more beneficial in some ways for some people going the real estate. Obviously, we are a little bit biased on that, but I think they just have each of their own little pros and cons. I think you should do both. I think a lot of people should do both.
Yeah. And it is easy, especially, you join a company, they offer it, you enroll, and it's sucked right out of your paycheck. You don't even have to think about it.
Exactly.
Right.
And then your tax professional is always telling you, did you get your maximum amount in there? Did you do your catch-up contributions? It's just like, well, yeah, I'm doing it,
Yeah. I would call it like check the box tax planning. Like
Yes.
make sure you're just
Checking
doing the basics.
boxes.
There you go.
I know that you ended up acquiring a short-term rental and that drove significant tax savings for you. Did you have an interest in short-term rentals prior to learning about the tax benefits, or like what were?
Yeah. I know it was always part of the long-term plan. Going back before, I was born and raised in the Silicon Valley, and then I went to school at San Diego State, met my wife there, married her there. She was from Cupertino, which is also Silicon Valley. And when we had our first kid in 2010, we moved back to the Bay Area and we bought a house there. And the Bay Area really changed as we were raising kids, and we just wanted to get out of there. The way we raise our family and teach them was not fitting whatsoever with the California laws and political scheme of California. Nothing against anybody that lives there, but it just wasn't fit for us. So we got out of there and moved to Texas. And that was the first point where I thought, I'm going to rent this house and keep it as a rental and buy in Texas. But there was just too many moving parts with 3 kids, new state, new city, new schools. So we ended up selling it. First, we put it on the market for rent, and then it was kind of no action. So we just listed it and it sold immediately. And we had an influx of cash so we could buy in Texas. So then the exact same thing happened to us in Texas. Like everything we wanted to get out of California for, all the reasons we left, we were in Austin. We were like right by downtown in Austin. We were like, thought we made it, we made it to Texas. Here we are, we're Texans. And then I was like, oh shoot, this is very similar to California in that city of Austin. So then we made the next move to out here where we're at now is called Dripping Springs, Texas. And that's what you think of Texas. It's like we have 20 acres and like 120 chickens, and like we're out in the country. But we kept the place that we bought in Austin as a rental. So that is my first rental property. And we had it on Airbnb at first. And then now we get long-term tenants in there. And man, people pay to be in Austin. It's crazy what the rent that we get for this place.
So that's the property that you've kind of been helped primarily with Justin, right? So that was like the 2022, I think you said. Can you walk us through I'm sure listeners are kind of interested, and I am too, because I haven't heard the full story. Can you walk us through just more of like the specifics, kind of the numbers and, just like ultimate like benefits of kind of what you saw from like the tax side?
Yes, sir. So we bought the house in 2019 and we paid $1,700,000 for it. But it was a big house. It ended up being, it was like $390 per square foot. It was a good deal. And we lived there from 2019 to June of 2022. And during that time, we dug out a pool. We changed the backyard to these 2 separate levels where it's like upper level and then some big staircase that goes down to this lower level where the pool is. And then there was we did a lot. We probably spent $400,000, closer to $500,000 on just making, because we thought it was our forever home. We're down the street from the school the kids go to. You could hear the announcements going off. It was like beautiful, like the most gorgeous oak trees you ever saw everywhere. It was like the best neighborhood, but the vibes weren't good. So 1.7 purchased for 500 in. We're in for 2.2 at that point. In January of 2022 is when I read the book and I started reaching out to tax professionals. And I told my wife, I'm like, are you like on board to move out of Austin? And she said yes. And second question, are you on board to keep this? Because we were looking at what we bought it for and what the market was at that point in Austin, and we could have sold it and bought something really nice in the country. But she was on board to keep it as a rental. And then so basically from January of 22 until June of 22, we were just like fixing stuff up. We put new hardwood floors in. We want to get top price for renting it. Little, cosmetic changes to the house, new blinds here and there. And then we moved out. We bought a ranch with our own money, this 20-acre ranch, moved to it. The first tenant we got was a 6-month tenant. They paid us 6 months up front for the year 2022. And Katie had, since January, been working on a rep status. And we were there by like September. We had already hit the 750. So we just kept loading them on top because there's all these court cases where it shows if you're at like 800, they go back in and they pull stuff out that doesn't count you down. So we were just like, let's pad this thing as much as possible. Cost segregation gets done for tax year 2022 in calendar year 2023. Early, like February. The the guy, who did we use? The guy was so cool. It was referred by you guys. He was such a cool guy. He offered to fly out, but then he said, if you can go and take these pictures, the cost will be less because you don't have to pay for a person to fly out and stay in a hotel. So I chose to go there to the property on a day where the tenants let me and take pictures of like everything that he asked me to. I pulled my 2022 tax return up for the year. The Schedule E for 2022, line 18, depreciation. We had 110,000 of rents. So that's what those people paid for 6 months there.
Wow.
I know. Ridiculous, right? 110 of rents, all the regular expenses, mortgage, interest, property taxes, $943,000 of depreciation. 943.
Crazy.
Holy cow.
That's insane.
We had a Schedule E loss in 2022 of 896.
Wow.
Holy cow.
So that was very useful for 2022. A carryover loss for 2023 of 496. And then we used that. And then 2024 was the first calendar year, just this April, that I paid tax since then.
I'm so sorry. Yeah, so sorry to pay tax.
People are like, when I tell people, they're like, I have a tax team, and I pay for them to file my taxes, of course, but I also pay a lot of money for them to like just meet with me quarterly. And before the year is out, be like, what are we going to do? They're like, oh my gosh, you're paying like $3,300 a year for like 1 hour Zoom calls. And I'm like, yeah, dude. Yes, I am. And they saved me exponentially more than that.
That's amazing.
Like, I read the book, I had the strategy in my head, but I couldn't have completed that from start to finish without Justin and the blueprint and everything to the end.
Yeah, that's amazing. And I imagine that a lot of that 900, probably some already within like your purchase at the 1.7, but with most of your renovation, that like roughly 500, it sounds like a lot of that actually went into like the land improvements, like the pool, the landscaping, a lot of that, right? Okay.
We hired this team that was like, they're like artists with land, and my wife, the steel work alone was like, the steel was insane how much steel that was going on.
Okay. Yeah. And just for listeners too, the land improvements are 15-year property, and that would have been eligible for bonus depreciation for those of you who are maybe a little bit newer to this. So that is probably, I would guess, right, obviously without seeing the specifics in the study, that was probably a huge portion of what drove that. So for those of you listening, if you're like, how do I, increase the value of my property? How do I maybe make this more attractive for renters? And how do I potentially get really efficient tax savings for the dollars that I invest? Yeah, you have to come out of pocket or find some financing for something that's, that large of expense in a project. But that can be a very efficient way to add additional value, higher rents, and ultimately get more tax savings. So for those of you listening, just wanted to point that out. But that's an amazing story, Zach. Amazing. 2 years.
Almost all of the 500 that we spent on the rehab was outside. Almost all of it.
Wow.
On the land. Yeah.
That's crazy. Yeah. I don't know if we know the exact number of tax dollars that was, but I imagine that's over the 2 years, hundreds of thousands of dollars. That's incredible.
Oh my gosh. Yes.
Yeah.
Like hundreds.
Yeah.
Hundreds.
Incredible.
Yes, sir. I mean, they're not all going to work like that, but that was because we did all that stuff because we wanted to live there and we created, and that's why we're able to get this kind of rent, because people go there, they're like, this is like a little oasis back here. It's like a upscale hotel, what we did back there. And that was on purpose because we were going to live there, and we felt like we had earned that. We wanted our kids to be happy and want to come back when they leave the house. And then we're like, let's get the hell out of here and use it as a rental. And it just turned out to work really, really, really well.
Yeah. Incredible. And it says also the good thing about it, you put all that work into the property, and now you still get to keep it too, as I guess another benefit of it, right?
Yeah. In between tenants, you better believe we're going there and hanging out.
But you're not, you're working, right? You're not just
hanging out yeah, exactly. Working. Yeah. That doesn't make it on the reps list.
Yeah.
That was the 1 year we did reps. We haven't done it since because I didn't buy anything new. This year we're buying something new, and Katie I got to get with Justin on the strategy for this year because I don't think she can use hours actually, yes, she can. Anyways, we need a whole new strategy for 2024.
With 2024 officially in the rearview mirror, now's the perfect time to start planning for how you're going to maximize your tax savings in 2025. With major tax changes looming under the new administration and IRS audits on the rise, navigating the tax code alone is now riskier than ever. Whether you're leveraging the short-term rental loophole, claiming the real estate professional status, utilizing passive losses, 1031 exchanges, or anything in between, our expert team of tax advisors at Hall CPA has your back. We'll help you uncover hidden opportunities and avoid costly mistakes that could put you at risk during an audit. With potentially tens of thousands of dollars of tax savings on the line, why wait? Visit www.therealestatecpa.com/podcast to request your free 30-minute discovery call today. Again, that's www.therealestatecpa.com/podcast for a free consultation. Let's help you ensure you keep more of what you earn in 2025. That's all for now, and we'll dive right back into today's episode. Another thing I think Justin had mentioned too is that on the business side, your financial planning practice, this is something I think a lot of people overlook because it's so focused on the real estate side of the tax equation, which is a tremendous amount of benefits. But also, like, didn't you convert to an S corporation too as well?
Yeah. See, I had been running, you guys are going to think I'm crazy. I had been running all of my profits and loss on a Schedule C as a sole proprietor from 2004 until 2023, because I started working with Justin, and it was that year I couldn't do it. But starting 2023, I started in S-corp, paid myself $120,000, took the rest as business distributions, and that alone, the savings on Medicare and Medicaid and Social Security was in the tens of thousands right there, which I just utterly wasn't doing. Oh, and by the way, now we have a rental and kids that are teenagers that are going to the laundromat literally and washing sheets that we can pay to like do these things. And we were doing it anyway, but he's like, pay them. Don't elect S-corp taxation on the LLC you set up for the rental property, because that allows the payments to them to be Social Security and Medicare free. And the fact that they're minors allows it to be federal income tax free. And you can get up to the 14,000. So all these things that I just simply wasn't doing. I went from this like, because as a financial advisor, you got to figure it out, especially when you start at 23 years old and you're trying to talk to people about their retirement plan. They're like, what do you know about retirement, dude? You can't even grow like a goatee. And so it's like, I had my head down. I couldn't even, it's like the painter who paints his house very last, right? You're taking care, you got to build the business and head down. And I remember my wife early on being like, dude, you just worked for a month in a suit every day and you owe them money for your cubicle rent and your parking space. And I'm like, yeah, babe, it's going to work out. You just trust me. But it was a grind. And it wasn't until very recently that I started to get my own. I mean, I was investing. I was putting money away and maxing out qualified retirement accounts, but not doing any real estate investing and certainly not incorporating my business and paying the kids, simply because I didn't stop myself. I didn't pull myself off the treadmill to read a quality book like that until then in the tax space. And I didn't have professional guidance. I had my guy, I'm not going to mention his name, but it was like, dude, send me your stuff. I'll file your taxes. And half the time it was like, that's not my middle name, dude. Like, how many of the, and he was all, my business is getting so big. I got 1,000 clients. I'm like, yeah, I can tell,
Yeah.
So that's very interesting, because maybe just to make this, and help me understand this a little bit, Zach, because you got into this kind of the interest, I think you said around January 2022, started reading this tax book. And so you're like, hey, I need to learn more. But even like after you read that, you were like, I need to take this a step further and have someone actually like help me implement, right? Like, I want to bounce the ideas off. I need to make this personal. Then I need someone to help me like guide me along the way, right? That was like the connection point of like where we fit in, correct?
Oh, 100%. Because I'm like, if I do this on my own and it gets called for an audit, after reading one little 112-page book, I'm not feeling confident on being able to effectuate the thing, just like people, if they want, can manage their own portfolios and not pay a 1% fee. They could easily do that. There's a ton of resources, but there's people who willingly do it because they want to make sure it's done right and they don't miss stuff and they kind of get out of their own way.
That's great.
Hey, real quick, if you've been a long-time listener to the show, then you know we give everything away for free, from how to use the real estate professional status and the short-term rental loophole to save tens of thousands of dollars on taxes, to upcoming tax changes, including the potential return of 100% bonus depreciation. We don't hold anything back. And the only way we're able to help more real estate investors is if you rate, review, and share the show. It just takes 15 seconds to leave a quick rating, review, or share with a friend who may find this information useful on their real estate journey. That's all for now. We'll dive right back into today's episode. It's crazy how many people that I speak to, or I'm sure Ryan speaks to too, where they hear a podcast or they read an article on like short-term rentals and they're like, oh, I'm good to go. I'm going to go in
Yeah.
7 days or less. I'm going to go
Yes.
book the time. And, you know, to be very fair to you too, it's like I can go and read an article on, you know, go invest, you know, 40% in the S&P 500 and, you know, whatever percent in this and that, and just call it a day. There's a lot more nuances to all of this stuff that I think than what like this Twitter world of, you know,
Oh my gosh, yes.
characters of how to do it. There's a lot of confusion. It's really, I think, refreshing to hear someone like, you know, who's a financial advisor who has a higher level understanding of finance to be able to say, hey, look, I still need specialists in this specific area.
Yes. And perfect example of this is you know, in my Instagram feed one day, I learned of the Augusta Rule. I had heard of this before in the golf tournament and how you know, you can rent your primary residence out for 2 weeks a year and not pick it up as income. And I'm like, oh, now I have an S-corp. I sent an email to Justin. Whereas if I didn't have a Justin or a Hall CPA, I would have just done it on my taxes and wrote a check for my S-corp to me personally for what market rent was for those 2 weeks. But I emailed Justin. I'm like, hey, what do you think about this Augusta Rule? I mean, if my S-corp rents my primary residence for 2 weeks, that could be a $15,000 write-off for my S-corp. And then I don't personally pick up income on that. And he sent a video recording of himself answering the question because he was like, it's too much for an email, but here's the deal. If you legit are going to do that and you have an itinerary, you're going to need all these specific things that you would have to do to make it actually a legitimate corporate event, which I wouldn't have. If I just watched that Instagram reel and did it, I would have wrote the check and that would have been the extent of it. I wouldn't have invited people here. And it's like, you can't just do, like, these rules exist, but they have to be legitimate. Like, that cost tag had to be legit. Like, it's all, if it was that, I would look forward to and invite a audit on 2022 because it was all 100% legitimate. Whereas if you just watch things and hear things and read books and try to implement on your own without tax professionals, that's the riskiest thing in my opinion of all. You know, it's one thing to know it; it's another thing to know how to freaking do it.
100%.
Right. It's one thing to know the strategy, but it's one thing to implement the strategy. It's two different things.
Yeah. So I'm the biggest fan ever. I'm going to get many more rentals. I know I'm probably in Hall's world. I'm probably tiny with, you know, one guy with one rental, but it was just the best thing. And I'm looking to repeat and repeat and repeat because, like I said, I have the value of sitting with real retirees for like 2 decades now and like listening to and being a part of their life. That's like my second family. My clients now, it's crazy how 20 years in doing this and leaving a big firm and reaching out to your favorite people and having them come with you. They're like my second family, and 60% of the people I do this work for are retired, pulling money out of their accounts every year. And the ones that have the smallest part of their retirement is the invested assets versus passive income streams like real estate are the happiest and most chill. And the ones that are like, oh my gosh, we had it like 2022 when interest rates went to the moon and the market was down. My 70-30 portfolio was down in 2022, I think 17%. And if you have a down year of 17%, then you got your required minimum distribution plus what else you need to take out on top of that because of lifestyle, living expenses. That's how you run out of money quick is distributions during down market years versus buying during down market years. So I see that as a tremendous value to bring to people who may not be able to like play visionary and feel what it's going to be like when they're not working for income anymore and just living off the money they've saved and the assets they've accumulated. And dude, just imagine how much more peaceful it is knowing that there's a check every single month or checks from all your rentals. And then what you need in addition to that, if anything, is coming from this portfolio that you have in investment accounts.
Yeah. And I just wanted to comment on one thing you said too. Just you kind of like subtly said this, but you mentioned like not being a big, you know, owner of like massive rental property portfolio or anything like that. And just for anyone listening, like to us, that's not a huge deal. We care more about like the impact that we're going to have in terms of like tax savings compared to like portfolio size. So even if it's like, hey, I've got one, but we can generate $300,000, $200,000 of tax savings, boom, great. Let's help you. There's a lot of opportunity here. And as we get into our calls and things like that, that's what we're looking for. Our whole goal is to maximize tax savings, as your goal with your Zach is obviously a little bit different with like financial planning. And maybe it's something to the tune of like, I want you to comfortably retire, whatever their goal is, right? You want to help them achieve that for financial planning. And ours is really tax savings and tax clarity. So for anyone listening, if you're like, oh yeah, I got to have, 10, 15, 100 properties. That's not the case. I actually hear that pretty regularly. Even just one, if we can find the tax savings there and there's an opportunity, awesome. yeah, we would love to be working with you. But yeah, great to hear that you're looking to grow too.
Yeah. And you guys took me on before I even had the one. I was like in the process of turning my primary into a rental. And I remember the first guy who was like the sales guy of Hall, who was, if this works, we'll get you in. But it was kind of like a feeler conversation.
Yeah.
He's like, yeah, when you have a rental, it may make sense because it's pretty expensive. I'm like, no, I'm 100% doing this. So let's just get into it. But he was actually like, when you get one, then we can really help you. And I'm like, oh, well, I'm going to have one in 6 months. So let's just start the process. And I was like, okay, I'm in there with the good guys. Because when you look at tax professionals, it's very rare to have the competency level that is displayed every single time by Hall. And this is like, guys, whoever's listening, they're not paying me to say this. It's personal experience. You just heard my story. And if anyone out there works with Justin Shore, you know exactly what I'm talking about. But it's just like, you don't have to doubt for a second that he doesn't know what he's talking about ever. You can tell right away.
Yeah, Justin's phenomenal. He's top notch. Like, he's always on the ball, has everything down to the letter. Like, Justin's great.
Super impressive, dude. Yeah.
I think maybe we could just hear a little bit more of kind of like, Zach, where you're headed with real estate. I know you kind of vaguely talked about like, yeah, planning to buy. I think people might be interested to hear a little bit more if you are buying. Sure. Like, you know, are you going to continue to buy long-term rentals, short-term rentals, single families? Yeah. Are you interested in multifamily? Especially if, you know, your wife is going to continue to meet something like reps maybe in the future, maybe not this year. You said you might kind of like, I'm not sure. But if you could kind of walk us through that a little bit.
Yeah. So I've talked to my wife about this too. And our plan for real estate investing is that same neighborhood we bought our home in, thought it was our home, turned it into a rental. There's always action in there as far as stuff popping up for sale. And it's high end. It's really like the zip code. If you go on Zillow and put it in there, it's for Texas, especially, it's really expensive, but the rental market is pretty crazy. And there's people that are like, oh, for 6 months, I'm remodeling my mansion, so I'll rent for this insane price over here. And I shouldn't say insane. It's definitely what you should be paying to be staying at a place like that. And it's actually a deal because people always undercut what you list it for. But we want to get a lot of places in that neighborhood. So the upkeep for Katie, my wife, is easy. We know now the formula for how to make improvements to them to maximize the depreciation that we'll get. And if we can have, at the end of the day, if we can have 10 properties in the same zip code that are all high-end luxury rentals, I just see that as a wonderful lifestyle for us to manage quite easily, and maybe have someone that we pay a salary to do the management eventually, or some of it when the hour requirements go down. You know, I think there's a certain point where you don't have to do 750 every year. Is it always 750?
Always 750.
It is?
Yeah.
Yeah, every year.
What's with the 500 hour rule?
Yeah, the way it works is like, to qualify as a real estate professional, 750 hours and more than half your total working time.
Right.
So let's say, so then you still have to prove that you materially participate in your rentals, right? So say, for example, someone's a real estate agent. They might meet the 750 hour requirement just by being a real estate agent. They're working as, you know, they're out there doing their job. But if they don't actually have any involvement in their rentals, then their rentals could still be passive. So for the most part, when there's property managers involved or you're managing multiple rental properties, typically you want to get 500 hours of material participation on your rentals. Now, if the way you got to the 750 hours was through pure rental properties, then you already met the 500 hour test on your way to 750.
Got it.
So that's kind of where that 500 rule comes in like in a scenario like yours.
Right. So even without property management, having her do it 100% of the time, if it's long-term leases, 12-month leases, it's really not a whole lot to manage, even if you have 5 or 6. And 5 or 6, geez, 5 or 6 would be all that you need, versus to get that gross rent amount from single family or multifamily, you need a lot more units, a lot more doors, just because of that area and what it rents for. So and it's kind of like my same philosophy I have for my financial services practice. My growth plan isn't to get as many new clients as I can. It's to expand what I'm managing for the people I already do the work for. There's a lot of money that people haven't given me yet, whether it's in other accounts or they just want to self-manage that segment of their wealth, and I don't go after it. Whatever they want me to manage for them, I'll do it. But I look at each household and see what's unmanaged by me, and that's my growth plan. So more dollars under management with less households that I'm doing it for. Same thing in real estate. I'd like to have a higher price point gross rent on less houses in the same area, just from a lifestyle standpoint, to make it easy on us to keep doing those hours and to not have to, be really like working crazily.
Yeah, economies of scale, having everything in one area. One of the biggest challenges for people who have these big portfolios, like single family rentals, for example, is they're all over the place, or they're low rent, or low rental properties. So you have to buy a lot of them to hit your income goals.
Right.
So it sounds like an effective strategy.
That's what we're going for. We'll see. We're one down, probably 4 or 5 more to go.
And how far away is that from you guys? A couple hours?
No, it's actually it's crazy. You feel like you're way out because it's so different than Austin, but it's a 35-minute drive in there.
There you go.
Freeway. Yeah. So we're trying to set it up. We're trying to set it up intentionally, man.
Okay, that's great. And just for even listeners too, for those of you kind of considering reps, just one nugget here. You don't have to buy something like Zack is doing where it's 30, 35 minutes away. It can make it easier because like your wife is going there and doing some of the improvements, especially when you guys were living there, right? It's like, hey, massive amounts of time she's putting in, helping with the landscaping improvements. So it can be easier, but I just talked to enough people and see enough things on social media where I think there's this misconception that people have to get something local or within a couple hours in order to make, real estate professional status, short-term rental strategy, whatever material participation test that you're trying to help yourself meet, that it has to be local. It doesn't have to, but it can make it easier. And it's kind of the same deal with like management. If you get a property manager, it can make it more difficult, especially if you're getting audited and it's like, they're really like kind of questioning because you have a manager taking over everything. It can kind of the same deal with management and buying local. So yes, buying local can be nice and easier to get there, especially for your wife, if you're going to plan to do that. And that's a lifestyle that you guys want, but it's not required is kind of my point. That's the only kind of highlight I wanted to say there, but that's great. I like that's close for you guys.
Yeah. Yep.
We covered a lot here on today's episode. Zack, I want to thank you so much for sharing your story and how everything turned out, and your experience working with us has certainly been awesome to hear. You are a financial planner. If listeners wanted to learn more about you, what you have going on, where would be the best place for them to do so?
Would just send them to my website. It's pretty simple. First name, last name.com. So ZackMattos.com. It's not the great of a website, but it's my website. And just know that if anyone's, looking for help planning out non-real estate related investment strategies, you won't get any pressure from me. I've been doing it a long time. And if it's good synergy and there's some things we can help with, then great. ZackMattos.com is where you can go to check it out.
Okay, cool. Well, we'll drop that in the show notes for anybody who's interested in learning more. I just pulled up the website. Looks good to me. So we'll drop that in the show notes. And thank you again, Zack, for coming on. We'll have to have you back on in a few years, check in, see how everything's going.
Thank you guys, man. Hall CPA, Justin Shore. Good part of my life now, man. I'm very fortunate to have you guys on the team.
Great.
Thank you.
Thanks.